Hey guys, it's Chris Mancola with the Mancola Group over at West USA Realty, and just wanted to give you our weekly market update. Hope everybody's doing well. Right now we're seeing a big shift in the market taking place. It's just kind of getting started. It's very exciting. So let's take a look at why this is happening and what the details are. Inflation rate slows. Oh, wait, let me share my screen with you. My bad. Okay, here we go. Okay, inflation rate slows again to 15th month low. This is from Market Watch. PCE shows a U.S. economy weakens. Okay, so I mentioned this before, and then again, a subheadline is rate of inflation eases to 5% from 5.5. This is what we're looking for to get the interest rates down in order to and again, I don't agree with everything the Fed does by a long shot, and they're way behind the eight ball on a lot of things as usual. And they're a whole nother story. But as far as what they're trying to do, as far as taming inflation, finally, late to the party, it's working. Again, like we keep talking about, we've been talking about this for months. And we based off of what Barry Habib from MBS Highway was telling us exactly what's happening. Started to really see a change and shift around November, which we talked about before, and we're starting to see it continue on. The big date again to look for is May 10th. That's when we're really going to see a sharp drop. I did this in another video about a week ago and a market update where we basically showed, remember when everything kind of went haywire last year on April, May with the markets and stuff with the housing market because the inflation was so high that they had to really start pumping up the Fed's fund rate even more and more. And then we saw interest rates go up. So it just cost more money to borrow money, basically. And they had to tame inflation. Finally, they got around to doing it. And we saw that those numbers are super high. Well, we're going to see that in April, May of this year over year, once the Treasury bond market sees that, oh, those numbers are super low compared to last year, and they've been coming down, we're super happy about this. And we'll already be in what's already the busy real estate season for us in the Phoenix area and a lot of places around the country because school lets out, right? Usually in May or June, typically for most areas, our area is May. So it's going to be just kind of like another igniting factor when that inflation shows that extra dip in April, May, especially, when the numbers come out for April in May on May 10th. That's going to be huge. But we see here in this article, they're taming inflation. Inflation's going down. We see, the slowing of the annual increases year over year in the inflation. Now, and there's still inflation is still, higher than we like to see. But we see, on the chart here, it's coming down, right? It's coming down. So again, once we, get to, this is April of 2022, then April, see that little ticker there? We're going to see a sharp, even more of a sharp drop off for us when we have these year over year numbers. But we see that it says here that that's the smallest increase in 15 months, though still well above the pre-pandemic levels, less than 2% annual inflation rate, which is what they usually like to see and where we had pre-pandemic. So in any case, let's keep going here. So this week we saw that the Fed raised the Fed's fund rate again. It doesn't directly, but indirectly could affect mortgage rates, as we always talk about. But basically, we had mentioned that it was only going to be 25 basis points, and voila, that's what it was. It was, a raising again, but a much lower amount of raising, 25 basis points versus the 50 or 75 basis points that we saw in the previous several months leading up to this. So they're firmly fixed on this inflation, taming the inflation, and inflation drives the mortgage rates. Inflation drives the mortgage rates always is what. So if the inflation goes up, rates go up, mortgage rates go up, inflation goes down, mortgage rates go down. So in Mortgage News Daily, it says the most stable mortgage rate trend since 2021. So seems interesting, right? It seems like a good thing. And we are definitely seeing this as inflation is tamed. We have demand destruction. Now, this also brings on, less hiring. It brings on some layoffs. Maybe, a lot of these companies during the pandemic had overhired. So now they're having to let people go. We don't want to see anybody lose a job, but it's just kind of the effect of what happens. Hopefully we don't see that tick up too much before things stabilize in the job market. But it is something that happens. People just aren't in business when we're in a recession, which we probably already are. Again, the federal government or the Federal Reserve will tell us that we've been in a recession, not that we are in a recession, because they're always looking in the rearview mirror. They're always behind the eight ball. They're always late to the party. Okay. They're usually on average 2 to 6 months late to that party. So most likely we're already in or headed into a recession. We'll find out about it after the fact. But in a recession, it actually is good for the housing market. And again, not that we want to see anybody lose a job, but interest rates come down during recessions. Okay. So when we have these factors of taming inflation, we have these other factors of, basically unemployment going up. We also at the same time see, for those who still have, income in their jobs, we also see that rates go down, and it's a great time to sell and buy, refinance, all those sorts of things. So that's where we're trending to. And we were up, we were like 3% last year. We went all the way up over 7%. Now, again, just average, this is just an average 30-year fixed rate they're showing here is around 6. But again, if you go through, mortgage broker, one of our preferred lenders, you're going to see rates for conventionals, right around 6, below 6, depending on the day in the week. And as we trend down, we'll see them come down even more. FHA is actually, a government loan, usually first-time home buyer. You might even get a lower rate with that. But you'll see a big difference depending on if you're dealing with a retail or wholesale lender. Always going to recommend a wholesale lender from the standpoint of what would be the best to save you money. So we can always talk to you about that. But anyway, we see that, our mortgage applications are up. Everything's ticking up. Locally here, we're seeing in the Phoenix area right around a 3% increase this week. The last couple of weeks, I had mentioned a couple articles in the last week nationally, we were up 7% within just a few days of each other. Before that, 28% the week prior. So mortgage applications are up. That's always a great indicator. As rates drop, we're going to see more of that. Of course, just natural. We're going to see more people want to put their home on the market, because now they're like, okay, well, I've got a super low interest rate right now. Why would I move? But now that they're getting the, lower rates, or lower rates are on the way, they may be thinking, okay, now I'll put my home on the market and move on to what I want to move on to. So we should start seeing that over the next couple of months. And as we go into the usual cyclical annual busy season of the spring and early summer. So, usually right after Super Bowl, right after Super Bowl, things heat up. We're seeing multiple offers on properties right now. We're seeing a lot more foot traffic and showings on the MLS and our Showtime system. A lot more foot traffic at open houses and all those sorts of things. So, and anecdotally, we're certainly seeing the same thing with our listings and the buyers that we're working with. So I mentioned this last week. I'm just going to mention it one more time because it's absolutely ridiculous. They must have been looking at old numbers for probably from December, instead of looking at where we are, where we've been the last few weeks, especially in the Phoenix area. But Goldman Sachs talked about 4 cities that will suffer a 2008-like crash. The article really makes no sense, because not only has things started heating up this year already for us in the Phoenix area, we're one of the cities mentioned, along with Austin, Texas, and San Diego, California, and San Jose, California. For Phoenix area, they're saying it's likely to increase first and then see 2008-like dips and decrease 25%. Well, first of all, we would see if we're going to be like 2008, we would see a decrease of 60%, like I talked about last week. We're not seeing that. We did have overall across the board about a 14% correction, but we were up around 30% year over year. Okay. So, or just over 30%. So guys, I don't, yeah, maybe your house went up to 500,000, but now it's only worth 400,000. But the year before it was worth, say 400,000. I mean, you're still ahead 50 grand in that scenario, right? And again, as we head into the busy season, as rates drop, we're going to see those numbers and demand go up, along with the fact that our, in 2008, we would have seen, for the Phoenix area, we would have had 56,000 homes on the market. Well, right now, we're sitting at exactly 16,651. I'm looking at it right now on my MLS ticker. So I don't know how, and that's kind of kept things in check and in balance by, demand went down when of course, as interest rates more than doubled year over year at one point from 3 to 7. Now they're back down again and trending down. Okay. But, and prices, of course, were up. So yeah, of course, there's going to be people in hibernation mode, kind of waiting till they can afford it or think it's a better move for them. Okay, just common sense. But as this market shifts again, going into the busy season and rates dropping, we're seeing this. And then the fact that we just don't have the huge supply has kind of kept these things in check. So guys, right now we are sitting at 78 closed days on market. We were over 5 months supply last week with what was going under contract, even though our inventory is down. Now we're at 4.19, which is actually about a 25% drop. And then our absorption rate is 23.89%. The average list price, not sales price, but list price is 725 and some change. And the average sales price, the actual average sales price is 528 and some change. List to sales price ratio is at 95.72. We usually like to see that around 97.8. Okay. Properties that went under contract and pending were 3,700. Usually we like to see a little bit more activity than that. And new listings that came on the market were 2,093, which was actually up a little over 10% from the prior week. So the 56.93% of the entire multiple listing service where homes are listed for sale and then syndicated out to all the third-party playground sites. Everything under 500,000 is in that bracket of 56.93%. So majority of the homes are under 500,000. 31%, just over 31% make up everything from 500 to $1 million, and then $1 million on up is 11.9%, and that's in the Phoenix area, greater Phoenix area. So looking further into the local market here in the greater Phoenix area, we talk about this every week. It's called the Cromford Market Index, the CMI from the Cromford report. And the people at Cromford tied right in with our MLS stats. And they basically have a metric where they get on their index between 90 and 110 is within a balanced market, 100 being completely balanced. Below 90 is a buyer's market, and over 110 is a seller's market. Right now, we are on the overall market index, 113.8, which is up about two points from last week. So technically we're over 110. So technically we're in a, minor seller's market. Okay. Just slightly to the seller. Demand is at 75.5. And so that means we are, there we're about 25 points away from absolute balance at 100. And then supply is at 66.3, okay, which again would put us at about 34 or 33.7 away from 100 in a completely balanced market. So we're seeing things kind of warm up. tick up a little bit into the seller category. We're up overall in all the cities. If you take them all individually in the greater Phoenix area, we're up 20% towards the seller market, okay, on the index for their points of percentages. They're up 20% towards, again, the seller market overall. And last week it was 22%, the week before 22, and I believe the week before was 19. So we've seen we saw in January the highest percentage of homes going under contract, okay, in any January, which again is a really good sign of things happening. Every home in the greater Phoenix, every city in the greater Phoenix area is trending toward up on the index, and that means it's all trending toward the seller's market. And Fountain Hills is the only one trending down, which usually it's always number one or one of the top two. Typically it's number one though, but it's still in a seller's market at 163. And then we see Paradise Valley's below that. These are all sellers market: Chandler, Cave Creek, Scottsdale, Phoenix proper, and Avondale, and Glendale, Mesa, Tempe. Those are all technically in a seller's market, not super crazy frenzy like before, but in a seller's market. And then we see that Gilbert and actually just Gilbert is the only one in a balanced Gilbert and Peoria are in a balanced market. Gilbert, Peoria, and Surprise are in a balanced market because Gilbert's at 108. Again, under 110, between 90 to 110 is within the balance range, 100 being completely balanced. So Gilbert at 108, Peoria 95, Surprise at 94, and then Goodyear's at 76. Let's see, Queen Creek 65, Maricopa City at 57, and Buckeye at 55. So those are all in a buyer's market. Okay, Goodyear, Queen Creek, Maricopa, and Buckeye buyer's markets. Okay, but they're all trending towards an upticking towards in the direction of seller or already in seller. So that would make sense with what we're seeing with the stats. So guys, I think that we're going to see things really start to heat up here as we go along. And I think that we're going to see that there's a lot of good things happening for sellers. I think that for buyers, you're still able to get concessions to sorry, for some reason I can't bring my big screen back up. Oh wait, there we go. Okay. Hello. So for buyers, I think you're still going to be able to get your concessions for now if you ask for concessions. However, again, keep in mind, we are starting to see more and more, multiple offers, a lot more foot traffic. Things are starting to heat up. I always tell people, look, we know May 10th, it looks like, where we're really going to see another big drop off. So those will be reporting the numbers for April. So in April, May, we should start seeing some really good drop. But I would say get ahead of that curve, because right now you can get the lower price, you can get the concession on the homes, and to refinance later, say, a few months down the road, and you're kind of ahead of that, you're not really, losing out. There's no out-of-pocket cost to do the refi. You're getting a lower price on the home now. You can probably get the concessions to get the buy down rates, the 3-2-1, 2-1 buy downs, which could get you, anywhere between 2, 3, 4% your first year. But if you can refi out of that, you can even bring because the seller's paying for those buy downs. You can even bring that money that's in the escrow account to your refi, and then have a fixed rate where you're good to go back to like last year numbers by the time we see these rates drop all the way down. So guys, if you have any questions at all, want more details on that, more of an explanation on that, we'd love to be able to help you out with that, along with our preferred lenders. Of course, you compare them to whatever lender you're working with, whether it be a new home, resale home, or you're looking to sell a home or both, we can certainly help you with all of that. And you know, you always tell people, may not be the best realtor, for you, not a realtor for everybody, but hey, it's worth a conversation to kind of get things started off and make sure that you're getting well taken care of, and see where things are set for you, what's best way to go for you and your real estate goals. So guys, 480-788-8569, or you can check us out at MancolaHomes.com, MancolaGroup.com, or email us at home@mancolagroup.com. And really would appreciate it too if you would like, share, and subscribe or follow us on all social media, whether it be Instagram, YouTube, Facebook, LinkedIn, Twitter. We're out there. And if you just look up Mancola Group, you'll find us. All right, guys. We'll talk to you next time. Thanks.